I'm Yahoo Finance Executive Editor Brian Sozzi, and you're taking a look at a live shot of the opening bells on Wall Street on this Wednesday morning. Big Bear AI Holdings ringing the bell at the New York Stock Exchange. Meme stock there, certainly. Chimera Therapeutics getting things popping over at the NASDAQ. Lots on our docket today. Tech stock investors are getting a wake-up call. Target will have a new CEO very soon, and retail earnings are rolling in fast. So much to get to, so little time, but we will aim to hit it all and then some. Now, Opening Bid is all about serving up investing analysis you need to know to unleash the power of your portfolio. We're digging into what's really moving stocks, giving you the unbeatable context to make decisions with all that money you have in your portfolio. I know you have it. Let's get a quick check on the major averages and go down to the NASDAQ in Times Square. Brooke DePalma is there for us. Brooke.
Good morning, Brian. What we're seeing right now across all three major averages, a bit of a mixed picture here. The NASDAQ holding on to that downward momentum that we saw on Monday, where the major indices fell the most in 2.5 weeks, down about 1.5% at market's close of the day. Now as the market opens, if you take a look at the YF Interactive, we're seeing the NASDAQ hold on to that downward momentum, down about 0.3%, largely led by individual stocks declining. We'll get into that in just a second. The S&P 500, also similar story there, down about 0.1%, whereas the Dow opening up in the green, up about more than 0.1% as we kick off the third day into this trading week. If you take a look at the heat map, what we're seeing right now as we open is all major individual stocks that led the losses on Tuesday extend into this morning's bit of a sell-off here. If we look at Nvidia, what we do know there is that all eyes will be on their report over the next week. On August 27th, they're set to report, and Dan Ives saying in a note this morning that what he wants to see and what he expects investors to hear is that he wants to see demand to supply 10-to-1 for Nvidia's chips. But there is some fear on the street that's getting baked into the stock here that they might exclude China from their third quarter guidance because of that pause in their ability to sell their chips to China. Once again, they also now have to pay a 15% fee to the White House. Another stock that really led the downward momentum on Monday that's extending their losses into intraday trading today is Palantir. That stock soared. Year to date, that stock was up more than 100%. And then over the course of the past 3 days, we have seen this downward momentum, down as much as 9% just in Tuesday's trading session alone. Now that stock opening lower, down nearly 3%. Wedbush's Dan Ives saying that he still believes that the Palantir could further grow their valuations over the coming years and that healthy pullbacks will happen. And we're certainly seeing a pullback here month to date, down about 5%. But once again, over the past 3 days alone, that stock is down more than 14% as that losses continue into Wednesday's trading day. If you take a step back, once again, we are seeing this rotation as investors pull away from those tech stocks, and as there's fear over this pullback in AI. UBS pointing out in a note this morning that they think that there's some caution that may be warranted in part of the cyclical parts of tech, but they remain confident in that broader AI sector long-term growth and resilience. Once again, the NASDAQ holding on to those losses in this morning's trading hours.
Brooke, I always chuckle when I hear pullbacks are healthy. I mean, people are losing money. What's healthy about that? Thanks, Brooke. I appreciate it. We'll check back with you in a second. All right, I'm kicking things off with your daily guide to the biggest market drivers of the trading day. Here's what I'm watching. Number one, a new CEO taking aim at Target's future. Target has named insider Michael Fiddelke as CEO starting in February 2026. He'll be taking the CEO baton from Brian Cornell, who has led the retailer through many ups and downs since 2014. I'll have exclusive details on this C-suite shakeup coming right up. Number two, the retail earnings calendar kicks into overdrive. Target also announced another horrible quarter as it battled Trump tariffs and cautious shoppers. Lowe's earnings were a little more upbeat, and it said it will make an $8.8 billion acquisition. I'll pick apart the numbers with the opening bid roundtable. And number three, watching tech stock charts. Complacent investors have been hit with a reality check on tech stocks. Finally, momentum favored Palantir getting drilled again this morning. Nvidia seeing some mixed action. Is the tech trade correcting? Maybe, yes. Here is the opening bid roundtable. Thomas Martin, Global Investment Senior Portfolio Manager, my dear friend Jeff Mackey on the Yahoo Finance roundtable, an investor. He's an investor and retail expert, and Yahoo Finance senior reporter Brooke DePalma is back with us. Jeff, I'm coming out with you right off the block on this Target news. For those not familiar, your dad, Kenneth, was essentially the founding CEO of Target. You've been in retail stores since you were a little kid. You and I have talked retail for about 20 years. Your take on this CEO shakeup and why the stock's getting hit?
Yeah, my dad was not a founder, would that it were so. But he was only the second outside guy to be named CEO of Target of 5. And now this makes 6 with the announcement today. The stock market doesn't love it, Brian. And I think what they don't love about it is less a reflection of Fiddelke, who seems like a perfectly reasonable guy who's dedicated to kind of fashion and getting the store, at least in theory, cleaned up. It's that this company needs an outsider. I mean, it's now 2/3 from its highs. It's not getting back to 270 anytime soon. Brian Cornell kind of ran out of gas, and to have his hand-picked successor come in, I don't know that the street feels like he earned it. I'm not sure he did. They need to clean that up, and they need some direction. And just the idea of accelerating on this downward curve is not so good.
Jeff, I got a chance to talk to Michael Fiddelke and Cornell on this news, and I asked Michael, how candid are you prepared to get in shaking things up at Target and getting off of that Brian Cornell script? I mean, both these guys have worked very close over the past 3 years. I mean, this is Cornell's hand-picked successor. You're in these stores. What are some of the things that he needs to change, not literally on day one? I mean, he knows the company. He has to come out here blasting. He's not going to have this honeymoon period.
No, he's not. And they really put him in kind of a tough spot here by having Cornell hang out until February. Because you're exactly right. He's going to have to come in. What Target needs is kind of, to be blunt, a little kick in the ass. And they need the stores clean, for instance. You know, you can be fashionable all you want, but people will not buy things that are lying on the floor of your store. You got to clean them up. They're clearly cutting back their spending on the stores. They're staffing on the stores. They need to fix basics like that, block and tackle. The entire business model of Target is being clean, being a little nicer, a little friendlier, a little kind of more welcoming, and then it leads to that impulse items. You make customers comfortable in the store, and then you sell more products than they thought they needed when they walked in. It's like magic sauce. When it's working, they're miles away from it right now, and it's a real problem. This chain continues to kind of struggle with its identity and figuring out what they're doing. Fiddelke might be able to do it. It's kind of a walking start, if you will. You would like someone to come in from the outside, maybe someone who knows a little less about the culture and is less forgiving of it, to go a little Michael Corleone on this turnaround.
Jeff, you know this. I actually thought it should have been you taking the reins. We'll save that for a different day. Thomas, let me get you in here. Lost in this CEO shakeup is news that, well, Target reported earnings. Earnings down year over year. Sales in stores down 3.2%. Margins under pressure in part because of tariffs and discounts. Any excitement for you as pertains to putting money to work in retail stocks here ahead of back to school and the holidays?
Right. Well, we don't own Target, and we've been watching it for a while, and we don't think that this is the news that would get us involved in it. You know, there's more of a structural problem with Target. They need to spend money, and they need to get e-commerce right, but they're going to have a trade-off between generating sales and generating margins. So we don't think that it's time for them. You know, we do own the quality of Home Depot, and Lowe's and Home Depot have been kind of neck and neck in terms of the stock market, and they're more or less a trade-off. You can make an argument that Lowe's is cheaper, but Home Depot is more of the quality. And this move into the higher-end pro business is something that Home Depot has been doing for quite a while, and there's a fair amount of competition in there. So Lowe's is coming a little bit late to the game there. On the other hand, you mentioned TJ Maxx, which is a longtime holding of ours, which is an idiosyncratic holding, a very specific strategy that customers absolutely love. They've been holding up well, and they're in the sweet spot of the trade down. We think those are the kind of issues.
And look at that company today, man. That's a great call. Congratulations on being long, TJX. They crushed. They operate in an entirely different ecosystem than Target. Target comes out, it's been 4 straight years of, boy, this happened, you know, sad trombone, and we missed sales because this happened or that happened or it was weather. TJX is like, you know what, we're just doing this treasure hunt thing. Yeah. Customers come in, they love it.
We're going to buy your crap from Macy's and we're going to sell it on a discount. I mean, you're right on, Jeff. Hold on a second. Let me get over to Brooke, because we're also watching these Walmart earnings. And Brooke, I think the story is teed up pretty straightforward for Walmart tomorrow. This was another challenging quarter for Target, in part because it's sending all of its shoppers over to Walmart.
Brian, it feels like we've been talking about this for years now, this tale of two different retailers as Target same-store sales growth continues to slump and Walmart seems to be gaining a share here. And that momentum is expected to continue as we make our way to when they're set to report before market open on Thursday. Same-store sales are expected to grow something like 4% after this same-store sales decline that we saw from Target. And what we know is that Walmart has been able to win over consumers, especially those key high-income consumers that Target really had a sweet spot on as these consumers went and got their Starbucks and shopped around and moseyed around the aisles here. Walmart has been able to snatch up that customer largely because of their influx on grocery as well as convenience. We also know that they're now offering same-day delivery on pharmacy. And so really Walmart has been able to strike this sweet spot between grocery, convenience, and delivery and pharmacy, that all in one-stop shop that they really leaned into, as well as those low prices that consumers are looking for right now in this environment. Target just hasn't quite struck that same beat with consumers, especially now.
Jeff, you make a good point. Target needs a kick in the ass. Let me make a hard right turn to the tech trade. Investors are getting a little bit of a kick in the ass today on Palantir, you name it. What do you think about some of this budding tech sell-off? And look, I mean, maybe it's justified. How could we sit here and think that Palantir is worth 300, 400, 500 times forward earnings? I mean, it's ridiculous.
Yeah, give them some slack, right?
Yeah.
I mean, we just kind of got started on the tech correction. We barely finished talking about. There are really kind of fairly inexpensive companies that are making nice moves on their stocks right now. TJX is not going to get people excited, but you're not going to lose 12% on it and be sitting there looking at your company and saying, okay, it's only down to 550 times earnings. Do I buy the dip here? No, just give it a rest. Everything needs a pause. If you're going to be so twitchy that it's going to shake you out, then you're better off selling earlier rather than later than just riding it out and living in denial right now. When you have perfectly kind of boring workaday stocks that are, Walmart has a great base at about 100. They're going to report good numbers tomorrow. They're going to feast on what Target can't do anymore. Go buy them. Rotate into some different stocks. Chill a little bit on tech.
Thomas, are you rotating out of tech here, or do you think this is just a healthy correction and you're buying any dip?
Well, I heard what you said about healthy corrections and your skepticism there. Nobody likes to lose money.
Thank you for watching, Thomas. Thank you for listening to the show. We will be having you back. Please make a note of that, producers.
Beautiful. But we're a little bit longer term investors. We are long-term investors. Our clients expect to make money, for their retirements and et cetera. So we believe in diversified portfolios. We pick good companies that we think are going to have good long-term track records, and plenty of tech companies fit into that category. Even Palantir fits into that category. But valuation, even though it doesn't matter until it matters, it does matter. And when you're up at the highs like we are, you're going to get corrections. I mean, look at the correction we had in 2022. That only lasted 6 months. There have been time periods where tech has corrected for much more significant time periods than that. But those same companies came back. And we expect to ride that through as long as the fundamentals are good. When the fundamentals change, even for some of these Mag 7 companies, it's time to get off and wait and see how things shake out. We would put Apple and Tesla in those two categories, while the rest of them are really competing well, and they're growing their revenues and their earnings. All
right, hang with me. We got a lot more coming up here on Opening Bid and with the Opening Bid Roundtable. Coming up, we're going to have our stock of the day, and we're going to dive into really all things, also this tech sell-off, I should add, and our stock of the day. Really excited to get that one over to you. We'll be right back. Welcome back to Opening Bid. City analyst Paul Lejwe isn't hiding when he thinks about Abercrombie & Fitch into its August 27th earnings release. Lejwe is slashing his rating on the stock to neutral from buy. While he thinks Abercrombie will beat on earnings due to strength at Hollister, investors may overlook that. Instead, more focus will be placed on potential negatives, such as the impact of Trump tariffs and how the third quarter started amidst a lot of consumer uncertainty. All right, let's fire up our stock of the day. The Wall Street Journal reporting this morning that Elon Musk is pulling back on his desire to create the America Party as he wants to focus more time on his many, many companies. That certainly piqued my interest on all things Tesla again and sent me snooping around for some fresh analyst coverage. I found it from William Blair analyst Jed Dorsheimer. Jed apparently spent last week riding around in Austin in robo-taxis. Those are new from Tesla. came away thinking the robo-taxi offers, quote, a glimpse into the future, and it's all very exciting. Jed also came back with some interesting numbers on the financial potential for robo-taxis. He values the robo-taxi business at $298 a share based on its operating profit potential and has a price target of $357 on the stock. Still with me, my opening bid roundtable, Thomas Martin, Global Investments Senior Portfolio Manager, Jeff Mackey, investor and retail expert, and Yahoo Finance Senior Reporter Brooke DePalma. Jeff, going back to here off the jump, Tesla, that story has quieted down a bit. Are you excited about robo-taxis? Because as I was picking apart the analysis on this particular note, it seems like so much of the current stock price reflects robo-taxi potential, despite what, only 4 or 5 cars being out there on streets?
$298 a share, specifically of robo-taxi value there, Brian. Seems aggressive to me. Seems a little like you might have just grabbed that number out of the air. If you want to be long Tesla, just be long Tesla. That's fine, but understand what you're getting, and perhaps not for robo-taxis. I think that Uber's going to be the players in that because they just find the customers the best. I think their deal with Waymo, who knows how that plays out, but whatever type of vehicles are being summoned, Uber's going to have action on that. Tesla's a whole different thing. It's Elon's a different kind of cat. I sat in the very chair you occupy now, Brian, in a prior iteration of Yahoo Finance, and I talked to Steve Jurvetson, a then huge VC out in the Valley, and asked him who the most impressive guy he ever met was, and he just said Elon without hesitation. Just kind of offered it like he's just the most impressive guy I've ever seen. He's a completely different cat. He's his own thing. If you're going to invest in that, it sounds like a terrible investment thesis, but then again, it stacks up pretty well compared to $300 a share for this hypothetical robo-taxi business.
You have indeed been a pioneer, Mr. Mackey. Thomas, over to you on all things Tesla. Now that the hoopla around Elon and his leanings in terms of politics has cooled off a bit, fundamentally, does a stock like this excite you at all?
Well, not now, it doesn't. It did when it was just really an EV stock, and when EVs were starting to go, you could really get underneath the fundamentals of where you were going to go with the total addressable market, who was going to buy it, why, what the costs were, their advantage, et cetera, which was huge for them. But now that that's just a fraction of what the stock is being valued at, you have all these things that are based on valuation and numbers that are 10 years in the future. Very, very hard to predict as to what the demand and the pricing is going to be for those. And we've seen with a lot of times with Elon, it's vaporware or vapor hardware, where you say it's going to be ready, in 6 months, and it doesn't end up being ready for a couple of years. So we're interested in the stock, but we're going to be very patient and wait until we have some fundamentals we can really sink our teeth into.
Jeff, real-time deep thought. If one is so excited about the potential for robo-taxis, what in the world does that mean to the trades over at Ford and General Motors? They're not making any robo-taxis. They're just making cars. We're not even going to be driving cars anymore.
If we look at it, Tesla's not making robo-taxis just yet either. So I'm not sure how you value a business where it's just some guy riding along, not touching the steering wheel so far. With any of these stocks, how do you know when to buy them? Well, if you've missed them so far, you got to buy a capitulatory moment. It's not an upgrade or a downgrade from an analyst. It's Tim Waltz laughing at Tesla shareholders last year. That was a great time to buy this stock. That was if they're kind of going that mainstream with the bearish takes, whatever stock it is, just go ahead and buy. We're not at one of those moments yet. So we talked about it earlier with the tech sell-off going on now. If you're long them, you're sort of inured to the pain, or at least you should be by now. It's not your first 8-10% dip or whatever's going on with the tech. And if you're not long them yet and missed them so far, well, you're probably a little early on a lot of these names. And I think that's the case with Tesla. It's going to just kind of slog along as a high beta function of the market.
And Brooke, I know you're also watching Tesla here.
Yeah, absolutely. And what I actually looked into when I look at the 1-year stock chart, that stock is still up more than 47%. And what we see, if we point out to YF Interactive, is really this sort of momentum of the stock moves based upon Elon Musk's time when he worked with the White House. After that November rally, after he teamed up with President Trump, we see that stock surge based upon implications that it can have for the EV market. Then when it came time when there was some turbulence between their relationship, that stock then moved lower come the time of March. Then in May, once he leaves closed the White House after he said that he was leaving that, his task to cut waste federal funding in the federal government. We saw that stock rally in July. We see a bit of a sell-off as he announced plans that he was potentially going to launch this new party. And now what we're seeing today is this stock see downward momentum down more than 2%, as it's largely seems like he's no longer going to launch that new party. And so there's lots of implications. It's not just Tesla anymore, but it's this major momentum and discussion around Elon Musk and his position at the company as well.
The stock losing its charge. I mean, I'm here all day, Brooke. All right, my question of the day now, Home Depot and Lowe's are both out. They're both shelling out billions of dollars to buy businesses that sell building products to contractors. The 30-year mortgage rate is off its highs, always good. Toll Brothers CEO Douglas Yearley said on his earnings release today, sales for luxury homes remain strong. So my question is this: is it time to go all in on playing a housing recovery? Thomas, what say you?
Well, I want to like these stocks, and particularly the home builders, because the long-term story is, we need more houses. So the home builders are right there to take advantage of that. But there's one simple problem, and that's affordability. Housing prices are too high, and interest rates are too high. And, interest rates going from 7% to 6.7% isn't going to do it. They're going to have to get below 5%. Will the Fed lower rates, and will we be on our way towards that? Maybe, but I don't see it in a hurry. So in the meantime, the housing market is locked. People who own homes can't really move. And that's a problem for these companies. So we want to wait for interest rates to actually come lower or the housing market to crack.
Jeff, I talked to Home Depot CEO Richard McPhail earlier in the week after earnings, and I asked him, how excited are you about a 25 basis rate cut? He pushed back at me. He's like, not that he wouldn't be excited, but his point was it takes a while for rate cuts to feed through the economy, and perhaps it's until it won't show up in a Home Depot results until 2026. So what are people betting on today then?
They're betting on Lowe's. Take a look at the stocks, Brian. These things are ripped like scalded chimps. You got like a 20% move on Lowe's from the lows a month and a half ago. They just turned in a positive quarter. People, they're doing projects again. They're kind of, these companies, Home Depot and Lowe's, are both really well-run companies that need a little macroeconomic help. And the stocks are already pricing in a rate cut. I disagree respectfully with the Home Depot CEO about how excited he would be. I think he's going to have his giddy pants on. He mentioned rate cuts multiple times in the conference call. So, it's like pretending he doesn't have a crush on a girl or something. It's just get over it. You want the rate cut. That's fine. You're running Home Depot. You should want rate cuts. But I think Lowe's is a way you can play it. We talked about being overpriced before. This is a company that's executing well. They're finally just out of their doldrums over the long term. And look at that chart for the last month and a half. We're kind of breaking out into comfortable territory, and we're still a relatively inexpensive stock that's just betting on a bit of a recovery, and they don't need necessarily an entire housing cycle to kick in. They just need people to open their wallets a little bit more, and I think that's what the stocks are pricing.
I'm going to go quickly off script here. Jeff, I want to give you a last final word on Target. It's really the big news of the day. Fiddelke's not scheduled to start until February 1st, 2026. Given the stock's decline, does he actually get to start on February 2026, or do you think something else can happen here and someone else comes in and gets appointed?
Does the board strike you as a bunch of go-getters out there to do the aggressive thing, to really provoke things? No, he'll get a run at it. Of course he will. Again, but he can't keep talking all the time. I don't think that he's a bad CEO. He's certainly not going to run it into the ground, more so. It's just a curious choice. And I think the board of directors had a chance to really give Target a constructive kick in the backside and be kind of objective outside observers and say, you know what, you're losing share. Your identity is not clear anymore. You got to get it together. And they didn't. And so that's what's happening with the stock. Now, that said, it's relatively cheap. People kind of want to buy the dip, but there are just better ways to get long stocks out there. I think he starts, but you're always going to be answering that question. Okay, how aggressive is he going to be? And he really, if I were Fiddelke, I would advise him to go in there and just go guns blazing pretty fast, pretty early, and stand for something. And I frankly would just kind of clean up the stores and spend more money there.
This opening bid roundtable put me in an amazing mood. And for that, I thank you. Thomas Martin, Jeff Mackey, Brooke DePalma. We'll talk to you soon.
Great. Thanks a lot.
Coming up, Julie Hyman has you covered for Market Catalyst. She'll drill more into the Target C-suite shakeup and the pressured tech trade. We'll be right back.